Hi, my name's James, and today we're taking you through everything I think is important about the Chinese economy. To start with, we're talking about China's investment-driven growth model, where the Chinese government, or Xi Jinping, wants manufacturing and construction to basically be there as long as possible. Unfortunately for him, as a share of GDP, construction and the secondary sector of the economy has taken a big hit, as tertiary or service sector jobs are beginning to take a bigger majority of the Chinese economy. The problem is, what fuels these jobs, or service sector jobs, is household consumption. And in China, it's historically been low, around 35%, whereas in many Western economies, it's around 6%. And this is why many economists made the recommendation for China to transfer from an investment-driven growth model to a household consumption-driven growth model.
As I argued in my previous video, for more stable economic growth, China should switch to a consumption-based economic model.
This is yet more evidence that China needs to boost consumption as a share of GDP. Excessive investment, whether it's in property or manufacturing, seems to be ultimately unsustainable if it's not matched by domestic demand.
So what these economists are saying is basically that this investment-driven growth model that Xi Jinping wants is unsustainable because it can only be financed through debt, and the natural tendency is for household consumption to lift up so it can fuel tertiary sector jobs. And because Xi Jinping is pumping so much capital into construction, manufacturing, the service sector is lagging behind, leading to sky-high youth unemployment, as China has around 11 million graduates per year, but the economy is still dominated by factories and real estate and manufacturing. However, in my opinion, I don't believe the transition from an investment-driven growth model to a consumption or household consumption-driven growth model is going to be easy because of this thing called a fertility crisis. And the problem is, there will be no consumers to consume, and they'll need to conduct mass migration, as many Western countries are doing, because as in China, both the United States and really every Western country, the entire world, is going through a birth rate crisis. And what this means is there will be no consumers. So China is basically going all in. Instead of going to consumption base, they're going to go and try and replace all the factory workers with robots. And I kind of like this approach because as the birth rate collapses, it's going to be a huge issue with the debt-to-GDP ratios as the GDP collapses if it's a consumption-based model. But if it's investment-driven, you still have a chance to at least fight until the end. Now we'll talk about China's short-run problem, which is deflation. This deflation was caused in part by the housing collapse in 2021, which saw new housing starts fall off a cliff. But as we can see, disposable income was not affected that greatly by this housing collapse. This is due to the fact that property makes up a small percentage of disposable income, and wages make up the large share of disposable income. And the only problem is that this housing collapse, houses were considered an investment vehicle for retirees. So you basically put everything you have into a house because China has very tight capital controls. They won't allow you to invest abroad that easily. So most people, or most Chinese citizens, chose to invest in housing. And when housing collapsed, they lost a lot of confidence about the future. So they decided to save more for retirement. The problem is this slowed down consumption. We can see that even as Chinese disposable income increased, the share of which Chinese citizens actually spent or consumed declined. This puts downward pressure on inflation or prices because as consumers demand less, prices fall. And the only way to get that back up is to somehow convince Chinese consumers to increase their spending by 13,000 yuan each, but we know that they're trying to save for retirement, so this is unlikely, and it's actually likely to increase this gap between disposable income and what they spend or consumption. This isn't likely to increase in the future because Chinese consumers are worried about the future. So you might be wondering, transitioning to a consumption-based model where there's going to be less consumers and they're consuming less is probably not sustainable or a good idea. So now let's talk about the other component of demand for Chinese goods, Chinese exports. As we can see, huge domination in both EVs, lithium, solar, and 5G, and really just complete miracles after miracles, yeah? We can see that EV car sales year over year at 22%, and they're completely dominating the market. The problem is export demand has stalled since about 2022. We can see it's flat, and the problem is that this demand shift that's fallen down because of Chinese consumers is supposed to be made up by Chinese exports. But if this is not happening, this demand is disappearing. The problem is prices begin to fall. We have big deflation. And we can see that industrial production is still increasing by 6.5%. So the supply of Chinese goods going up and the demand is falling because both the Chinese consumer is consuming less And foreign consumers are demanding less of Chinese goods, which is flatlining and causing demand to fall off a cliff. And this is pushing prices all the way down towards zero or deflation. When demand for Chinese goods is stagnant or decreasing, the only way industrial production can go up is increasing debt-to-GDP ratios or decreasing interest rates, both of which are unsustainable in the long run because interest rates will eventually hit zero and debt-to-GDP ratio gets to a certain level where creditors will not want to lend. Since China has an investment-driven growth model, loans and capital will flow into whatever investors think is going to grow the fastest. So from 2000 to 2010, non-financial corporate debt-to-GDP ratio exploded, and this is what drove the initial growth from 2000 to 2010. But later on, this growth flatlined, and investors chose to spend more or invest more into real estate, whether by loans or through capital. And we consider after the 2020 crisis or 2021 housing crisis, a lot of the growth has just come from the government. A lot of the housing debt-to-GDP ratio is flatlined, and also the corporate debt-to-GDP ratio is flatlined. And it's only the government that's financing all the debt. And without this government debt financing these firms, a lot of these firms will collapse. As we can see here in recent years, the uptick in the finished goods percentage of business revenue ratio, which basically means how much a company produces or firms are producing in China relative to their ability to sell. And as we can see, about a 50% deterioration in what they can sell from what they produce. And we can also see a huge collapse in China's enterprise profit margin, basically meaning that a lot of China's firms are becoming unprofitable. Also, the return on capital that foreign investors would get by investing in firms in China is decreasing, and this is causing interest rates to be cut so that investors will not be discouraged from investing in China. This creates basically huge debt rises, zombie firms, and causes more deflation to persist. As we can see, there's been a huge rise in unprofitable zombie companies within China. These require rollover loans, subsidies, and implicit guarantees from the Chinese government so they don't collapse. And these become a huge burden on the Chinese government and a huge financial drain. As we can see, a huge percentage of Chinese companies are now unprofitable in the industrial sector, and this is probably a lot higher considering it's only 2023, and this is going to be a huge financial drain on the budget. So along with these zombie firms being a huge financial drain, we know the housing crisis that started in 2021 caused housing prices to collapse in China, leading to a huge fall in China's government fund revenue. But this is only one of the four main budgets of the Chinese government. We have the general public budget, which is the biggest one. We have the government fund budget, which we spoke about, which is the housing one. And we have the state capital operations budget and the social security fund for the retirees. And what this has caused is huge deficits to be run in China in recent years. There's been huge blowouts in the costs from zombie firms, the real estate crisis, and more retirees. And all these added together cause a huge blowout in the budget deficit. And as we can see here, these huge deficits have a huge impact on the government debt GDP, pushing it up